You've been doing everything right, working hard, earning decent money, maybe even saving a little, and yet you still can't tell if you're actually ahead or falling behind. That feeling isn't confusion. That's what happens when nobody ever showed you which numbers actually matter. Most finance channels drown you in spreadsheets, budgeting categories, and generic advice about cutting subscriptions. That's noise. In 8 years of working in personal finance, I found that there are exactly 5 numbers, just 5, that determine whether someone builds wealth or stays stuck. Not 50, not a dashboard full of metrics. 5. The people I've worked with who learned these 5 numbers and started tracking them went from financial fog to complete clarity. Some of them hit their first $100,000 in net worth within 18 months of making this shift. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems, and honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people cut through the noise, understand their money with clarity, and build real wealth without needing a finance degree. All right, let's get into it. Number 1, net worth, your real financial scoreboard. Here's something I want you to understand right away. Your income is not your wealth. Your salary is not your score. The number that actually tells you where you stand financially, the only number that does, is your net worth. When I first calculated mine, I had a decent salary and felt like I was doing okay. Then I sat down and actually did the math. Assets minus liabilities. What I owned minus what I owed. The number that came back was $4,200. That was my entire financial life summarized in one number, and it was a wake-up call I desperately needed. Simple whiteboard showing assets column minus liabilities column equals net worth. Most finance apps will show you your account balances. That feels good because the numbers look bigger. But a balance is not the same as net worth. If you have $8,000 in a savings account and $31,000 in student loans, your net worth is negative $23,000. The app that only shows you the $8,000 is lying to you by omission. Here's how you calculate it right now. Write down everything you own that has value. Your savings, your investment accounts, your car's current market value, any property. Add those up. Then write down everything you owe. Credit cards, student loans, car loans, mortgage balance. Subtract the second number from the first. That result, whatever it is your starting line. It's not a judgment, it's just the truth, and you can only improve what you're willing to measure, okay? Keep watching because what comes next is the number that actually predicts whether you'll ever be financially free. Number 2, savings rate. The number 1 predictor of financial freedom. Most people think the path to wealth is earning more money. And yes, income matters. But here's what the data actually shows, and this is the part that most finance channels completely gloss over. Your savings rate, the percentage of your income that you keep and invest, is a stronger predictor of financial independence than your salary. Let me give you 2 real scenarios. Person A earns $120,000 a year and saves 5%. That's $6,000 a year going toward their future. Person B earns $65,000 a year and saves 30%. That's $19,500 a year. Person B is building wealth nearly 3 times faster despite earning almost half as much. Person A versus Person B annual savings over 10 years. The research from the FIRE community, Financial Independence Retire Early, shows that at a 10% savings rate, it takes roughly 40 years to reach financial independence. At 25%, it takes about 32 years. At 50%, it drops to 17 years. The savings rate is not just a number, it's a multiplier on your entire financial timeline. Here's where it gets interesting. You don't need to jump to 50% overnight. The goal is to increase your savings rate by just 1% every single month. If you're currently at 5%, get to 6% next month, then 7%. By the end of 1 year, you're at 17%, and you've barely felt the difference month to month because each step was so small. But the compound effect of that progression is enormous. Okay? Number 3, debt-to-income ratio, the silent killer of wealth. This is the number that banks use to decide whether to lend you money. But almost nobody uses it to manage their own financial health, and that's a massive mistake. Your debt-to-income ratio, or DTI, is simple. Take your total monthly debt payments, credit cards, loans, car payment, mortgage, and divide that by your gross monthly income. Multiply by 100, and you get a percentage. That percentage is your DTI. Calculator on screen showing monthly debt payments divided by monthly income, result displayed as a percentage. I'm going to show you something in just a minute that took me 2 years to learn. But first, the benchmark you need to know. A DTI below 20% means you're in strong financial health. Your debt load is manageable, and you have real room to build wealth. Between 20% and 35% is a yellow flag. You're functioning, but debt is limiting your options. Above 36%? That is the danger zone. At that level, almost every extra dollar you earn goes to servicing past decisions instead of building your future. Most financial content shows you the number and stops there. What they don't tell you is what to do with it. If your DTI is too high, there is one move that works faster than anything else. It's called debt stacking with income separation. Every time you get any extra income, a bonus, a side hustle payment, a tax refund, 100% of it goes to your highest interest debt. Not 50%, not split between savings and debt, all of it. Because until your DTI is below 20%, reducing debt is your investment strategy, okay? Keep watching, because the next number is where wealth actually gets built. Number 4, investment return rate, making your money work for you. Here's a question most people can't answer. What is your money actually earning right now? Not what you hope it's earning, not what your financial advisor told you it could earn. What is the actual annualized return on your invested assets right now? Most people have no idea. They know they have some money in a 401k or a few stocks, but they've never sat down and calculated the actual percentage their portfolio is returning. Brokerage account screen showing Portfolio Performance tab with an annualized return percentage highlighted. This is the part most people completely miss, and it costs them dearly. If you have $50,000 invested and your return rate is 4% annually, you're making $2,000 a year on your money. If that same $50,000 is in a low-cost S&P 500 index fund, returning the historical average of 10%, you're making $5,000 a year. That $3,000 difference doesn't sound dramatic until you compound it over 20 years. At 4%, that $50,000 grows to approximately $109,000. At 10%, it grows to $336,000. Same money, same time, a difference of $227,000 just because of the return rate. The fix here is not about picking winning stocks. That's gambling. The fix is about eliminating drag. High-fee mutual funds, savings accounts paying 0.01%, cash sitting idle in a checking account, all of these are silently lowering your effective return rate. Move idle cash to a high-yield savings account, earning 4.5% or higher. Move actively managed mutual funds with 1% or higher expense ratios into low-cost index funds with expense ratios of 0.03% to 0.05%. Those